Do you know what the biggest tax bill of your retirement might be? Most people don't. They spend decades saving carefully, working with an advisor, building a real foundation, and then you retire. And in a couple years, a tax bill arrives that looks nothing like you expected. And it's not because you did anything wrong. It's because two parts of your retirement income started arriving at the same time. And when they stack together, things start to change. I'm Matt Landon. This is Money and Meaning. And today we're talking about the retirement tax trap, specifically what happens when Social Security and required minimum distributions show up in the same picture. Now, if you have significant retirement savings, this matters to you. So I want to talk about it. Retirement income is taxed differently than a lot of people expect. The first thing to remember is that how retirement income actually gets taxed. Most people assume their taxes are going to go down when they stop working. And for a while, that's often right. But there's something that catches people off guard. Up to 85% of your Social Security benefit can be subject to federal income tax. That's not for everybody, but for most people with significant savings, it is. And the reason is because I say up to 85%, because it's dependent upon what's called your provisional income. There's an IRS formula that's used, and it adds up your adjusted gross income, any tax-exempt interest, and then it takes a look at your Social Security as well. If that number crosses over certain thresholds, your Social Security becomes taxable. So for most people with retirement accounts and investment income, these thresholds aren't hard to reach. So here's what we see all the time. Somebody retires in their early 60s, their income's relatively low, their taxes feel manageable, they feel good about where things stand. Then they hit RMD age, and those required minimum distributions start. When RMD and Social Security tax together, that's the part that people tend to miss. Required minimum distributions are mandatory. Once you hit age, it used to be 70 and a half, then it was 72, then it was 73, and then for some people, it's actually a little bit later than that. But once you reach that magical age of RMDs, the IRS requires you to take a certain amount out of your traditional retirement accounts every year. This money is taxed as ordinary income. So what happens is that RMD doesn't just add to your income, it also pushes up your provisional income calculation, which means more of your Social Security can be taxable at the same time. Think about the third level. This can also affect what you're paying in Medicare premiums. So not only is more of your Social Security taxed, but also the withdrawal to cover that Medicare premium jumps up as well. So that Social Security check gets slashed again. Think about how this works in practice. You're a couple in retirement. You're taking Social Security. You have some investment income. Things feel manageable from a tax perspective. Then your RMDs begin. And because that additional income doesn't just get taxed at your current tax rate, it can push you into a higher tax bracket. This can bring more of your Social Security becoming taxable. It can trigger those Medicare premiums. And by the way, those are based on your income from 2 years prior. So if you did a large Roth conversion, you may not feel the impacts of it from an income standpoint next year. It's the following year. So we've worked with families who have mapped out their retirement income carefully, and they still found themselves in a higher tax bracket in retirement than they were in their final working years. And it's not because the planning was wrong. It's because no one looked at what happened when all those income sources arrive at once. That's the retirement tax trap. It's not dramatic. It just quietly shows up. So the planning window is really before those RMDs begin. And here's the thing that I think you should focus in on, or the part that matters most, is the best time to address this is before it happens. When you think about that window, it's usually somewhere between retirement and the year that RMDs begin. That's where your taxable income tends to be lower and where real tax planning opportunities exist. One of the most useful ways to do this is with a Roth conversion. If you're in a lower income year, you can move a portion of your individual retirement account into a Roth. You do have to pay those taxes on it now at today's rate, but that money is now growing tax-free from that point on, and it doesn't have to be included in your RMD calculations. That means less required income, less Social Security taxable, and potentially lower Medicare premiums. Now, these conversions work best when done gradually over a period of years, and they require some cooperation and some coordination between your financial advisor and your CPA. But here's the thing. Most people don't think about this window until it's already closing. The decisions that shape your retirement tax bill, they usually happen quietly. in the years long before those RMDs begin. That's why planning ahead matters the most. When you're working with a CPA, oftentimes they're helping you calculate what you owe from last year's tax return. That's tax preparation. That's very different than tax planning, which takes a proactive look and says, let's go out 1 year, 3 years, 5 years. Let's run the tape out and see what's going to happen if we make this change versus if we make that change. If we do a large Roth conversion versus if we don't. What is this going to do come April? Well, what is it also going to do for you 5 years down the road, 10 years down the road, or even thinking about that legacy planning and passing it on to your kids and grandkids? So here's a simple checklist for you to think through. One, find out when your minimum distributions are gonna begin. If you're under the age of 73, you've got time to plan, but don't just assume they start at the same time as your neighbors because you may not be the same age. Two, get an estimate of how large your RMDs are going to be. Advisor, we can really model this based off of your current account balances and expected returns. Three, start looking at Roth conversions and whether or not they make sense this year. If you're in a lower income window before RMDs begin, this could be worth doing. It's something to consider and it's part of a real conversation. Four, ask your advisor to walk through the provisional income calculation with you. Understand how your Social Security is going to be taxed along with your other sources of income. It's important. And then finally, five, check whether your income level will affect your Medicare premiums. This surprises people a lot more than you. So if you wanted to tack on a bonus, maybe call it number six, I would just say make sure your CPA or your tax planner, that make sure that they're looking at things with your financial advisor, not separately, together. You need to have your financial planning and your tax planning included in all together. This isn't super complicated. It's easy to do, but it does require you taking the steps of looking at the full picture and thinking through it meaningfully. You've worked hard to build something meaningful. You've done the savings, you've done the investing, you've made real sacrifices. You deserve to keep as much of it as possible. Taxes in retirement aren't just about the year that folks are in, they're shaped by decisions made years earlier, and it continues on for years later. So I don't want you to make some kind of a snap decision because this kind of clarity, it doesn't come from just winging it. It comes from confidence and knowing that your accounts and your plans are put together and you've accounted for things that most people don't see coming. So if you want help thinking through your retirement tax picture, we'd be happy to walk it through with you. Thanks for listening to Money and Meaning. I'm Matt Landon. We'll see you next time.